Dear students, we'll solve a problem on assessment of companies applying MAT. This is video number 10. You have got a problem here wherein profit and loss account of Bhagwan Company Limited for the year ended 31st March 2020 is given. We will look at the other information first along with the profit and loss account items. Company has a long-term capital gain of 1 lakh which is not credited to profit and loss account. So if you look at the profit and loss account, it is not credited to profit and loss account. Anyway, while computing total income under capital gains head, you have to take this 1 lakh as a long-term capital gain. And while calculating the tax thereon, you have to apply 20% and thereby you have to calculate the taxes. When it comes to book profit, since it is not already added to profit and loss account, it is not to be added again. If it is already there, no question of deducting, it should be part of book profit. But if it is not already credited, it is not to be credited as per one of the case laws. So it is not to be credited or it is not to be part of book profit while applying MAT. Okay, depreciation under section 32. See, if you look at the debit side, this depreciation is there 5 lakh, whereas as per Income Tax Act, that is under section 32, it should be 4,50,000. Now what you can do is you can add 5 lakh to net profit and deduct 4,50,000 from net profit while computing book profit. While computing business income. Let me repeat. While computing business income, starting point is net profit. To that you can add depreciation as disallowed item 5 lakh. And then deduct rupees 4,50,000 from net profit while computing business income. Or else what you can do is excess depreciation 50,000, 5 lakh minus 4,50,000. That can be added back to this net profit of 16 lakh. Okay, then you have got here brought forward business losses 5 lakh for tax purpose, and again unabsorbed depreciation for tax purpose 2 lakh. So what you have to do is first you have to compute business income, then you have to find out the possibility of set off of these 5 lakhs, and if there is still surplus you can set off unabsorbed depreciation. Unabsorbed depreciation can be set off against any head, but brought forward business loss should be set off only against business income. Okay, this is about computation of business income and adjusting these things against that or setting it off against that. Come to brought forward business loss for accounting purpose and unabsorbed depreciation brought forward 2 lakh. Here, while computing book profit, you have to take these two things. There is deduction from book profit, that is brought forward business loss 4 lakh or unabsorbed depreciation 2 lakh, whichever is less. So 2 lakh rupees is the minimum here, therefore that should be deducted while computing book profit. That's all. This has nothing to do while computing total income, whereas it has to be considered, or these have to be considered while computing book profit. Whereas if it is given for tax purposes, that should be considered while computing book profit, business income and total income. Okay, further more details I will provide you while solving the problem. Yes, so you are required to calculate total income, book profit and tax liability. Okay, yes. Now you see, while computing business income, let us think about calculation of business income. So in the case of business income, starting point is net profit, and if there are any disallowed items, they are to be added. So here you have to find out whether there are any disallowed items. Salaries and wages are allowed, rent and rates are allowed, repairs are allowed, Selling expenses are also allowed. Depreciation is not allowed. So 5 lakh has to be added. And then what is allowed as per Income Tax Act? 4,50,000 should be deducted. Or else excess depreciation of 5 lakh minus 4,50,000 should be added back to net profit of 16 lakh. Income tax is not allowed while computing business income, therefore it should be added. Proposed dividend is also not allowed, therefore that's also added to 16 lakh. So these are the items of additions. Come to the deduction, transfer from general reserve. This is the only item that is to be deducted from net profit while computing business income. See here, see, net profit as per profit and loss account, 16 lakh. Then you are adding disallowed items like depreciation, 5 lakh. Income tax, 3,60,000. Proposed dividend, 2,70,000. Together, 11,30,000. So this has to be added to 16 lakh. So that comes to 27,30,000. Now, let us see the items of deduction. Transfer from general reserve, which is credited to profit and loss account. That is not allowed while computing business income. So it is deducted. Then what is allowed under Indian Income Tax Act? That is section 32, depreciation, 4,50,000 should be deducted. Alternatively, see here, addition is 5 lakh, deduction is 4,50,000. So what you can do is the difference you can add. Excess depreciation, so you can take here 50,000 and thereby you can finish off the treatment of these two items. Alright, we have taken like this, so 6,50,000. So business income before set off is 20,80,000. Now you have got two items to set off, 5 lakh brought forward business loss and other one is unabsorbed depreciation. Both can be set off because we have got enough money, 20,80,000. First set off 5 lakh, so what remains is 15,80,000. Then unabsorbed depreciation, 2 lakhs. What remains finally after set off is 13,80,000. Now computation of total income. Income from house property, nothing is there here, no income. Business income calculated here, 13,80,000. Capital gains, which is not credited to profit and loss account, here you see 1 lakh. This is to be taken under the business income head. Okay, so capital gain, long-term capital gains 1 lakh. Income from other sources nil. So gross total income is 14,80,000. The deductions under section 18, there's nothing to be deducted here. So 14,80,000 is the total income. Total income is nothing but taxable. Now come to the computation of book profit. So let me take you again to the problem. Here, what are the items to be added to net profit? Even in the calculation of book profit, starting point is net profit. I already told you about this in the earlier problem. Several problems we already solved. So net profit is the starting point even in the computation of book profit. So 16 lakh. So what are the items to be added? So depreciation 5 lakh should be added and later on same amount should be deducted. Then income tax is not allowed, that is to be added. Proposed dividend should be added. So all the three items to be added. Now what are the items to be deducted? So transfer from general reserve should be deducted. And again 5 lakh should be deducted, depreciation. Not this one, 4,50,000. It is the same amount should be deducted. Now you may wonder why same amount is added once and why same amount is deducted once again. The reason is if there is depreciation on revaluation of assets, then that is not to be deducted. So only normal depreciation should be deducted. But here you do not have additional information. Therefore, same amount is added and same amount is deducted. Alright. So these 1 lakh are not to be added, but if they are already credited profit and loss account, they are not to be deducted. And then 4 lakh or 2 lakh, whichever is less, that should be deducted. So net profit as per profit and loss account 16 lakh, depreciation 5 lakh, income tax 3,60,000, proposed dividend 2,70,000, 11,30,000, together 27,30,000. Deductions, depreciation, same amount I told you, same amount is deducted here. Transfer from general reserve, 2 lakh. Then brought forward business loss or unabsorbed depreciation, whichever is less. So this is from accounting point of view. So 4 lakh or 2 lakh, whichever is less. 2 lakh is the least one. So together it is 9 lakh. 27 lakh 30,000 minus 9 lakh means 18 lakh 30,000. This is the book profit. As the long-term, so I have given a note here. I already explained this. As the long-term capital gains are not included in the profit and loss account, they are not to be added to net profit while calculating the book profit. If they are included in the profit and loss account, they are not to be deducted from net profit while calculating the book profit. So this note I have already explained in other problems also, earlier problems, and in this problem also I have explained 2-3 times. I think by now you have understood the treatment of this item very clearly. Now we'll look into the tax liability part. So we have completed total income computation, we have completed book profit. Now we'll go for tax liability. Now here the rule is, it is like this: tax on total income or normal tax or tax on book profit, whichever is high or higher. It is like this: tax on total income, or we call that normal tax, or tax on book profit, whichever is higher. Let us calculate tax on total income first. 14,80,000 is the total income. You know, total income consists of long-term capital gain of 1 lakh. On that, you have to apply special rate 20%. So that comes to 20,000. Then again, you have to find out whether there is any short-term capital gain taxable at 15%. Here it is not that. Then again, you have to find out whether there are casual incomes, like for example, lottery income or income from horse race, winning from horse race, crossword puzzles, etc. But here, no such items are there. Therefore, leave it alone. Now, after excluding 1 lakh from 14,80,000, I mean 14,80,000 minus long-term capital gain 1 lakh, the remaining total income is 13,80,000. On this, you have to apply 30% tax. So that comes to 4,14,000. The total tax is 4,34,000. Now you have to add surcharge if applicable. Surcharge is applicable only when the total income exceeds 1 crore. But here it does not exceed 1 crore, so not applicable. So the amount remaining the same after adding surcharge. Then health and education cess at the rate of 4% on the total of taxes and surcharge. That comes to 17,360. As a result, tax on total income is 4,51,360. Alright, so we have calculated the tax on total income. We will calculate the tax on book profit. Book profit is 18,30,000. So same thing is brought down here. 18,30,000 on that. Tax rate is 15%. In some textbooks it is given 18.5, but for the assessment year 2020-21, it is 15%. So tax at 15% on 18,30,000, that comes to 2,74,500. Surcharge is not applicable, so amount remaining the same. Health and education cess at 4% on 2,74,500. So let me make it very clear. It is 4% on 2,74,500. As a result, it is 10,980. So total tax on book profit is 2,85,480. Now let us calculate the tax liability. Tax liability is equal to, see the formula, tax on total income or tax on book profit, whichever is higher. So tax on total income is 4,51,360. Tax on book profit is 2,85,480. Of these, tax on total income is more than the tax on book profit. So tax liability is 4,51,360. Since the normal tax is more than the tax on book profit, MAT is not applicable. MAT is applicable only when the tax on book profit is more than tax on total income. Here, MAT is not applicable. So this is about this particular problem. Similar problems we have already solved, and therefore this may not be a difficult thing for you. Anyway, thank you for listening.